The current shifts in the financial landscape are concerning, suggesting that the composition of investment portfolios may need to change significantly. While we can't predict the future with certainty, it's essential to have a clear understanding of our current position. Analyzing today's market conditions can provide insights into tomorrow's opportunities. For instance, in 1980, the Federal Reserve's funds rate peaked at 20%, and I was paying a bank loan at 22%. Fast forward to 2020, and the Fed funds rate dropped to near zero, with my loan rate at 2.25%. This dramatic decline in interest rates over 4 decades has been pivotal in shaping financial markets, arguably being the most critical financial event of the last half-century. From 2009 to 2013, the Federal Reserve lowered the funds rate to combat the global financial crisis, leaving it low for an extended period. This easy money environment benefited borrowers and asset owners, fostering a thriving economy marked by the longest bull market and economic recovery in history, with minimal defaults or bankruptcies. The discussions surrounding Silicon Valley Bank often highlight this easy money climate. However, we are now entering a more challenging era. The easy money days are behind us, which raises concerns about financial stability. The United States holds the status of the world's reserve currency, allowing us to print dollars to meet our obligations. This unlimited capacity provides temporary relief but introduces uncertainty about the long-term implications. The current trend of using potential defaults as negotiation tactics is precarious. Our reserve currency status hinges on the dollar being perceived as the safest in the world. If that perception shifts, we could face dire consequences. Companies that historically borrowed easily now find it harder to secure financing as lending standards tighten. Interest rates, I believe, are likely to stabilize between 2% and 4%, a more normal range after years of emergency low rates. This environment has fostered complacency, leading many to believe that low rates are the norm. Such assumptions overlook the potential for a significant pivot in monetary policy. In terms of returns, while the S&P 500 has averaged about 10% annually over the past century, alternative investment avenues are now yielding attractive returns. Credit instruments, such as corporate loans or high-yield bonds, offer comparable or even superior returns with added safety since they typically provide earlier payouts in case of defaults. The last decade has been relatively forgiving for businesses, with most bankruptcies occurring during challenging refinancing conditions. If borrowing becomes difficult, the likelihood of defaults will increase, especially as companies face higher costs to service existing debts. Reflecting on past financial crises, each bailout has been larger and more complex than its predecessor, leading to a potential scenario where the next crisis may surpass the Federal Reserve's capacity to respond effectively. Investors should focus on assets that can withstand a liquidity crisis, such as real estate, commodities, and other tangible assets. The dollar's status has evolved significantly over the decades, with potential repercussions stemming from recent U.S. economic sanctions. While sanctions can be effective, overuse may prompt targeted nations to seek alternative payment systems and currencies, thereby undermining the dollar's supremacy. Investment strategies should remain adaptable, as the market's dynamics can shift rapidly. While it's tempting to rely on forecasts, history teaches us that both macroeconomic conditions and individual company events can lead to unpredictable outcomes. The reactions of market participants play a critical role in price movements, necessitating an understanding of the psychological factors influencing market behavior. The most common mistake investors make is assuming they can accurately predict future market movements or that positive corporate news will directly translate to stock price increases. Instead, investment strategies should focus on identifying undervalued opportunities and understanding that the market is not purely mechanical. In conclusion, maintaining an informed and adaptable investment approach is crucial. As we navigate through these evolving market conditions, diversification into safer, tangible assets while being prepared for the challenges of a less accommodating economic environment will be essential for long-term success.